The next 3 weeks are about to decide the entire direction of Q2, and if you're not prepared, you're going to get caught on the wrong side of the move. What's good, y'all? Welcome back to the new Black Wall Street. This week is not just about earnings. This is about inflation, the Federal Reserve, and major catalysts that are about to move the entire market. What is about to happen in the next 3 weeks matters a lot, and this short window of time can set the tone for the entire second quarter. If you are not prepared for what is coming, you might get caught on the wrong side of the market. Markets move based on new information. Big news events on specific dates can cause prices to change very quickly. It is crucial to know when these events are scheduled to happen. Here are the key dates you need to circle on your calendar for the next 3 weeks. Each one holds a piece of the puzzle that traders are trying to solve. The order of these events is important. Each release will shape expectations for the next one. This is the roadmap for the market's immediate future. First up, Producer Price Index, PPI, April the 14th. Measures inflation from the perspective of producers, manufacturers, shows price changes for goods before they reach store shelves. Rising producer prices can warn that consumer prices may follow. Next, SEC CLARITY Act Roundtable, April 16th. This is not a vote, it is a public discussion about the future of crypto regulation. Tone could signal regulators leaning friendly or leaning restrictive. Main event, FOMC meeting. April 28th to 29th. The Fed will discuss monetary policy. Almost nobody expects an interest rate change. Market pricing shows a 94% chance rates hold steady. Traders will hang on every word. The Fed's statement reveals how they see the economy and inflation. A cautious tone could calm markets. A worried tone could spook them. This meeting sets the stage for everything that follows. The market has been in a holding pattern. We saw a nice rally after the temporary ceasefire between the US and Iran was announced on April 8th. That good news pushed Bitcoin past $72,500 and gave stocks a lift, but now that initial excitement has faded. Traders are looking ahead. They see a calendar full of events that could either confirm the rally or completely reverse it. This is why prices have been chopping around without a clear direction. The big money is on the sidelines, waiting for more information before committing to a major move up or down. This is not a time for complacency. It is a time for active preparation. Understanding the key dates is the first step. Knowing the potential outcomes is the second. Having a plan for both scenarios is the third and most critical step. The market is giving you a brief moment to get your house in order before the next wave of volatility arrives. Use this time wisely. The decisions you make over the next few days could have a major impact on your portfolio for the rest of the quarter. The market is focused on 3 fundamental questions. The answers will determine the next major trend. First, is inflation finally cooling for good? The last CPI wasn't terrible, but it wasn't great either. The market needs clear evidence prices are easing. Otherwise, fear of more Fed action lingers. This question matters across markets, stocks, and real estate. Second, will the Fed stay neutral? At the next meeting, the Fed faces a choice: signal comfort and patience, or hint that stubborn inflation makes them nervous, possibly opening the door to rate hikes. The market wants the Fed on the sidelines. Any sign of hawkishness would hit risk assets like tech stocks and cryptocurrencies. Third, will regulators give clear rules to crypto? The SEC's CLARITY Act Roundtable on April 16th is critical. The SEC sending its Reg Crypto proposal to the White House was a positive step, but the market wants more. Clear rules would remove a massive cloud of uncertainty. If the roundtable signals delays or hostility, it could trigger a sell-off in digital assets. Let's break down exactly what you need to know, starting with the dates that matter most. Now, let's imagine a world where everything goes right over the next 3 weeks. This is the bullish scenario. It could give risk assets a powerful green light. This outcome depends on a sequence of positive news. It starts with the inflation data. If both the PPI on April 14th and the CPI on May 12th come in softer than expected, it would be a huge relief for the market. It would signal that the worst of the inflation fight is over, giving the Federal Reserve room to breathe. With softer inflation data in hand, at their FOMC meeting on April 28th and 29th, they could confidently deliver a neutral message. They could emphasize that they are data-dependent and see no need to become more aggressive with interest rates. This is exactly what the market wants to hear. A neutral or dovish Fed is like fuel for a market rally. It tells traders that borrowing costs are not going up, which encourages investment and risk-taking across the board. In this positive environment, good news on the regulatory front would act as an accelerant, especially for crypto. If the SEC Roundtable on April 16th is constructive and hints at progress for the CLARITY Act, a major source of fear would be removed. With a 72% chance already priced in for the Act's passage in 2026, positive momentum could build quickly. This, combined with the successful launch of new products like SUI futures on May 4th, would signal that the crypto industry is maturing and becoming more integrated into the traditional financial system. When all of these factors line up, the market gets a clear signal to move higher. Risk appetite soars. Money that has been sitting on the sidelines in cash and bonds starts flowing back into stocks and cryptocurrencies. Tech stocks, which are very sensitive to interest rates, would likely lead the charge. Bitcoin and other digital assets would catch a strong bid. In this scenario, traders would feel confident buying any small dips, and the market could begin a new, sustainable leg up for the second quarter. This is the path to new highs. Now we must consider the opposite outcome. This is the bearish scenario, where a series of negative events raises a red flag for investors. This path also begins with inflation. If the PPI report comes in hotter than economists are forecasting, it would send a jolt of fear through the market. It would suggest that inflation is more persistent and stubborn than previously thought. This would immediately raise concerns about what the Federal Reserve might have to do in response to control rising prices. A hot inflation report would put the Federal Reserve in a very difficult position. At their FOMC meeting, they could no longer afford to sound relaxed and patient. Instead, they might feel compelled to adopt a more aggressive or hawkish tone. They might talk about the possibility of more rate hikes later in the year if inflation does not cool down. The mere suggestion of future tightening would be enough to trigger a significant market sell-off. When the cost of money is expected to go up, traders and investors become much more risk-averse. This tightening financial environment would be made even worse by negative news from other areas. If the earnings reports from major companies in the finance sector disappoint, if the earnings reports from major companies in the tech sector disappoint, it would confirm fears of an economic slowdown. Weak earnings combined with a hawkish Fed is a toxic cocktail for stock prices. For crypto, a negative outcome from the SEC Roundtable or a lack of interest in the new SUI futures launch would add fuel to the fire. Rising regulatory fear on top of a bad macro environment is the perfect recipe for a deep correction in digital assets. In this bearish scenario, liquidity dries up quickly. Traders rush to sell their risky assets and move into safer havens like the US dollar. This dash for the exits can cause sharp, painful drops in stock indexes and crypto prices. Key support levels would be tested, and if they break, the selling could accelerate. Automated trading systems and stop-loss orders are triggered. This is how a simple pullback can turn into a much larger correction. This is the environment where unprepared traders get caught and suffer significant losses. The single most important crypto level to watch, in a market full of noise and conflicting signals, focus on one single critical price level. For the entire crypto market right now, that level is Bitcoin at $62,000. This is not a random number, it represents a major technical and psychological support zone. How the market reacts around this price will tell you about the health of the trend. Watching this level provides a clear, simple signal amid macro complexity. Its importance cannot be overstated in the coming weeks. Bitcoin at $62,000 must hold for the bullish structure to remain intact. Think of it as the foundation of the current rally. As long as price stays above this level, the bulls remain in control and dips are buying opportunities within the uptrend. It's a zone where many buyers previously stepped in, and they're likely to defend it again. A strong bounce from here would be very positive. However, a decisive break below $62,000 changes the picture. A clean break and close below signals the bears have taken control. It would invalidate the bullish structure and open the door for a deeper correction. Such a move would likely trigger a wave of selling in Bitcoin and across the altcoin market. It suggests momentum is lost and traders should expect more downside and higher volatility soon. The move will most likely happen after the CPI data or the Fed meeting. Use this level as a simple guide for your strategy. Earnings season adds another layer of risk. We are right in the middle of corporate earnings season. Over the next 3 weeks, some of the biggest and most influential companies will report quarterly results. Major banks, technology giants, semiconductor firms. These reports add another layer of risk and opportunity. Their performance can amplify the market trend, or it can completely contradict it, resulting in confusing and volatile trading sessions. Two powerful forces meeting. On one hand, the macro story driven by inflation. On the other hand, the micro story from individual companies. If macro news is bullish, soft inflation, neutral Fed, and big tech reports blow out earnings, it can create a powerful upward surge. Good news from both sides reinforces positive sentiment. Rallies can become very strong, ideal for bulls, but the interaction can be negative. Imagine bearish macro, hot inflation, hawkish Fed. If major banks or chip makers report weak results and poor guidance, it can make a bad situation much worse. Weak earnings confirm fears. Sell-off becomes much more severe. Bad macro, bad micro news. A double whammy with nowhere to hide. This is why the coming weeks could be so volatile. Fed and inflation reports set the mood. Earnings determine stock and sector reactions. A strong report can make a stock rally on a down day. A weak report can make a stock plummet on a stable day. Real trading opportunities exist, but moves can be fast and unforgiving. You must watch the big picture and company-specific news. Navigating a market that is waiting on major news requires discipline. This is not the time to be making wild guesses or trading based on emotion. You need a clear and simple set of rules to guide your decisions. Following a few basic principles can help you protect your capital. First, have a plan before you enter any trade. This is the most important rule of all. Know your exact entry price. Know your stop-loss level. Know your price target. Your stop-loss is the price where you exit if it goes against you, limiting loss. Your target is where you take profits. Write this down before you click the buy or sell button. It removes emotion. It prevents panicking during volatile swings. It prevents getting greedy during rallies. Trade your plan, not your feelings. Second, be patient and wait for confirmation. Don't try to guess inflation reports. Don't try to guess the Fed meeting. This is a losing game. Let the market react to the news first. Wait for the data to be released. Let the initial chaotic price swings settle down. Then look for a clear signal or pattern to emerge. Does the market hold key support after bad news? Does it break out above resistance on good news? Waiting for confirmation raises your probability of success. Third, size positions according to risk. Reduce size when volatility is expected to be high. This is a powerful risk management move. A smaller position limits devastation if a trade goes wrong. Your number one job is to protect capital so you can trade another day. Reduce size to give yourself room to be wrong without blowing up. Survive first, then thrive. Prepare, don't predict. The next 3 weeks are undeniably critical. They have the potential to set the market's direction for the rest of Q2. We have a series of major events lined up. Crucial inflation data, a pivotal Fed meeting, key regulatory discussions. The market is holding its breath, waiting for these catalysts to provide a clear signal, a powerful green light or a blaring red flag. Your job is not to predict which scenario will play out. Your job is to be prepared for both. Preparation beats reaction every single time. Watch the key dates we have outlined. Keep a close eye on that critical $62,000 level for Bitcoin. Understand how earnings season can add another layer of volatility to the mix. Following simple rules will keep you grounded, planning your trades, waiting for confirmation, managing your risk. The market is giving you a moment of calm before the potential storm. Use this time to review your portfolio, define your risk tolerance, write down your trading plan. If you want real-time breakdowns, plays, and market insight, tap into the new Black Wall Street community. We're not reacting, we're preparing. I'll catch y'all in the next one. This video is for educational purposes only and is not financial advice. All trading involves risk. Always do your own research. Stay disciplined, stay patient, let the market come to you. The next 3 weeks will be fascinating to watch. Be ready for the green light, and be ready for the red flag.